In this video, we're going to look at accounting for natural resources. So what makes natural resources a bit different from the other plant assets we talked about is that they need to be physically removed from their natural environment and then converted into inventory. So examples would be mining properties, where, for example, gold is extracted from the ground, oil, gas reserves, timber. Once all of those are extracted from their natural environment, they are considered to be part of property, plant, and equipment on the balance sheet. So that's where those natural resources will show up. So it's not until those natural resources are removed that they're considered to be part of inventory. Now, a mine or an oil reserve, it doesn't depreciate. Okay, so it's important. It doesn't depreciate, but rather it's gradually depleted as that natural resource is removed from the ground. So once we remove all of the coal from a coal mine, the mine is then fully depleted, and that space would be either just left alone, sold, or redeveloped for something else, for another purpose. But once that coal is fully removed, the coal then becomes inventory on the books that is then going to be sold. So let's look at an example here. So Rainbow Minerals pays $48 million to acquire the Red Valley Mine, which is believed to contain 5 million tons of coal. The residual value of the mine after all the coal is removed is estimated to be 8 million, so assuming that's what they can sell the space for. The depletion that will occur over the life of the mine is the original cost minus the residual value, or 40 million. So if we want to find out what the depletion rate is, we start with that original cost of 48 million, subtract out its estimated residual value of 8 million. So we have $40 million of depletable cost, right? So we have $40 million here of depletion that will occur over the life of this mine. And we want to divide that by the total tons that is expected to be extracted from the mine. So they tell us here that they believe this mine has a total of 5 million tons of coal. So we're going to divide that 40 million by 5 million tons at the bottom. So if we do the math for that, we take the 48 million minus the 8 million, that's 40 million, divided by 5 million at the bottom. So when you divide those two numbers, we get 8 million. So the depletion, sorry, not 8 million, but $8. So we get $8 here per ton. Okay, so every time that a ton of coal is mined, that represents $8 of depletion. Okay, so again, 40 million divided by 5 million gives us $8 per ton. So now, when we're at the end of year 1, and we mined 2 million tons of coal, so let's assume we mined 2 million tons of coal, how will we determine the depletion, the total depletion expense for the period? Well, we know what the depletion rate is. So if we know that we mined 2 million tons of coal, and the depletion rate is $8 per ton of coal, well, $8 times 2 million, that gives us $16 million of depletion. Now, remember those 2 million tons of coal that you mined, that is coal that was extracted and now becomes inventory. So how are we going to record this $16 million of depletion here? Well, first we're going to debit our inventory account for $16 million, since that's the amount in dollars of coal that was mined. And then we're going to credit an account called accumulated depletion. specific to the Red Valley mine, but I'm just going to write accumulated depletion here. We're going to credit accumulated depletion for $16 million here. So once that coal is mined and added to the inventory account, we can sell that inventory. So once we sell some or all of our coal, the cost of that is going to be moved from inventory into cost of goods sold. And accumulated depletion, just like accumulated depreciation, is a contra asset account. So it represents the portion of the mine that has essentially been used up or depleted to date. So on the balance sheet at this point, under the PP&E, property, plant, and equipment section of our balance sheet, you would see the asset for mining properties for the Red Valley mine. Remember, we paid initially $48 million for that, so you'd see the Red Valley mining property listed at $48 million, but right below that we would list its accumulated depletion account. So less accumulated depletion for the Red Valley mine, and we know the accumulated depletion at this point is $16 million. So the amount left over of that mining property that has not yet been depleted is $32 million. So remember, we know that the residual value that they estimate of the mine is $8 million. So if the amount of it that hasn't been depleted yet is $32 million and there's a residual value of $8 million, then there's still $24 million of coal to be extracted from that mine, and the amount of depletion still yet to be recognized. So that's how we not only calculate a depletion rate, but how we determine the overall depletion within a year and how we record that on the books.